Today is Monday, July 21st, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Bowman, ADMIS Senior Market Research Analyst, and JP Steiner, ADMIS Associate Economist. Starting with the cocoa market this morning, Mark, how is cocoa demand holding up in the face of the record high prices of the past couple of years?
Well, last week we probably had the most vivid example yet of high prices hurting demand. You had the quarterly grind numbers come out for Europe and Asia, and they were sharply lower than last year. North America's was down, but not by as much. Starting with Europe, Europe was down almost what came in at 332,000 tons, down around 7% from last year. And that was the lowest second quarter number since 2020. Asia came in at 177,000 tons, down from 211,000 for the same period last year, and that was down 16%. And that was the lowest for the period since 2017. As I mentioned, North America, not so bad, 101, almost 102,000 tons, down from 105,000 last year, a 3% decline, but that was still the lowest in a decade. And it seems like these declines are a delayed reaction to the high prices. Grinders have been working through supplies and now are since have had to face rebuilding their stocks, and now they're faced with higher prices. Market did react to it with a steep sell-off on Thursday after the Europe and Asia numbers came out. Bounced Friday, though, the North American number came out after the market closed, and so it recovered off there. Now, if we go to all three regions, the decline was 9%, if you add all three up. And the total grind for the three regions since the start of the marketing year in April is now running roughly about 5% below a year ago. The ICCO is currently forecasting a 3% decline, so these numbers do suggest a total grind could be revised lower in upcoming reports. If we do a 5% decline overall, that would add about 73,000 tons to global ending stocks and would raise the stocks to grind ratio to 32% from a current estimate of around 30%.
Mark, let's visit the natural gas market. What is the natural gas supply situation?
Well, we are in build season, but U.S. storage has been increasing at a faster than average pace this year. Last week, storage increased 46 billion cubic feet versus a 5-year average of 37 for the week. And the weekly builds have been above the 5-year averages for 16 out of the last 18 weeks. Now, total storage is around 3,052 BCF, which is down from 3,209 a year ago, but it's above the 5-year average of 2,978, which is about a 6% increase over the 5-year average. So our supply not as burdensome as last year. We worked through some supply fairly heavily early this winter when we had a string of really cold weeks. But since then, we've just been gradually working higher. We do have some warmer than normal temps this summer on average, but no heat dome and not enough to slow the builds. That's because U.S. production running so strong. As of last week, through July, they had been 107.1 billion cubic feet per day so far for July. The previous record was 106.4 from June. So we're running at record levels. And on top of that, the Baker Hughes rig count this week showed natural gas rigs in operation up 9 last week to 117. And this was up from 103 a year ago and was the biggest rig count since March 1st, 2024. And that may be a reaction to the restart of permitting for building U.S. LNG export facilities under the Trump administration after Biden had suspended them.
Last question, Mark. How does the U.S. cotton crop look?
Well, it looks pretty good. Last week's crop progress showed 54% of the U.S. crop was rated good to excellent. That was as of July 13th, and that's up from 46% on average and 45% a year ago. Texas was 46% good to excellent versus an average of 31%. So Texas, the biggest producer, is also looking really well. Georgia and the Delta, not so good because of either, in case of Georgia, maybe not enough rain. They're 63% versus 66% on average, slightly lower. Arkansas and Mississippi both considerably lower because of their heavy rains. Mississippi was 48% versus 65%. Now, as the next reports this afternoon, we could see some more deterioration in the Delta. We don't expect too much in West Texas. U.S. and the Southern Plains and Delta are both expected to dry out during the next week or 10 days, which should be beneficial for both regions. Eventually, Texas will need some rain. I might also add that the drought monitor shows that only 3% of U.S. cotton production is in an area experiencing drought, which is quite low.
JP, looking at the financial markets, how does Japan's election affect its potential for a trade deal with the U.S.?
So Japan held elections yesterday on Sunday, and Japan's ruling coalition lost its majority in the parliamentary election there. Now, that could potentially set back the delicate trade negotiations that have been taking place with the U.S. This does come at a crucial time as well. The August 1 deadline is just over a week away, and we haven't seen any signs of a major breakthrough in negotiations. If no deal is made with the U.S., Japan will face a 25% tariff, which in all terms will significantly hurt its export-focused economy and could potentially tip the scales of what has been a very stagnant economy recently into a recession. Now, this means that Prime Minister Ishiba said that he would continue to negotiate with the U.S. Despite his future remaining uncertain. His weakened position as well means that his government may struggle to persuade enough lawmakers to back any agreement if once made, if it does make one with Washington, especially if it does involve concessions on sensitive sectors such as agriculture or autos. Talks with the U.S. have been bogged down, specifically over auto tariffs in particular. The auto sector is the mainstay of Japan's economy. Tokyo has been seeking relief on a 25% tariff that President Trump has imposed on imported cars, which is squeezing profits at their automakers such as Toyota and Honda. So in essence, although we will just have to wait and see, especially within the next coming days, if any sort of trade deal happens, the election Sunday really has the potential to throw a wrench in trade talks with the U.S. if no deal can be made in the very short term.
Lastly this morning, JP, what will higher tariffs on the EU mean for the European Central Bank?
Yeah, so the European Central Bank is expected to leave borrowing costs unchanged for the first time in a year at its meeting this Thursday. But the looming tariffs from the U.S. might determine whether or not the pause in rate reductions is permanent or temporary. The Eurozone's annual rate of inflation did reach their 2% target in June, while the central bank's economists expect it to fall below that level in 2026 and expect inflation to rebound slightly in 2027. The ECB did complete the difficult task of bringing inflation down from more than a high of 10% in late 2022 without pushing the economy into a recession, and then subsequently cut rates 8 times since taming inflation, leading markets to anticipate that there will not be a rate cut this year, along with comments from ECB officials that indicated the bank will not cut rates. So this week was largely priced in with no rate cut in sight. However, on the tariff front, the biggest threat to the economy is President Trump's 30% tariff threat, much higher than the current 10% level that's already in place. If the 30% level goes into effect, that could lead to a lot weaker economic growth and weaker inflation than the ECB had previously expected or forecasted with the 10% rate. The uncertain picture of what level of tariffs the bloc will face and its potential impacts on the economy will likely lead the bank to adopt more of a wait-and-see approach, much like the Fed back here in the States. This will also likely result in the bank not giving any precise or clear guidance on its future path on monetary policy at this meeting as well. With such high uncertainty, it would not really make sense for the bank to issue such statement or such a specific statement regarding its future policy when the tariff picture remains volatile ahead of the August 1 deadline. Another thing the bank needs to keep an eye on as well has been the recent strength of the euro. It's appreciated around 15% against the dollar since January, which has surprised economists as the currency of a country facing tariffs normally weakens. But we have seen the euro appreciate and the dollar weaken in the wake of tariffs. The stronger euro should keep inflation lower by directly lowering the cost of imported goods and services to the EU. But on the flip side, that also makes the problem of higher tariffs even worse for the Eurozone, making European goods even more expensive for importers on top of the tariff rate in the U.S., which would further compound the European goods, making them even more expensive. So that dynamic really has the potential to slow the Eurozone economy and keep inflation low. So should tariffs on the EU rise above the current 10% level and the currency remain strong, the ECB will likely have to respond by cutting borrowing costs further than anticipated.
Thank you both. Remember, the views and opinions expressed today in this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.